Hi everyone, thank you for tuning into Token Metrics TV. This is Jad, your quantitative analyst at Token Metrics, and this is the Quant Insights. Today we will be talking about a very nice topic, which is option strategies. How to combine put options with call options with your long position or your short position to have really good strategies to either bet on future outcomes of the underlying price or to hedge against future outcomes of their underlying price. So this builds off of our previous video where we introduced put options and call options, how they work, the nomenclature, and all that. So this will be a follow-up on that, and we will dive a little bit deeper on option strategies. So just a quick recap. We have two options that we want to concern us with, is the call option and the put option. So just to remind you guys, a long call option means just buying a call option, is a bet that the underlying price, the price of Ethereum or Bitcoin or any other cryptocurrency, will end up being above the strike price at expiry or maturity of that option. So here, the long call option, this is your profit on the y-axis, and then you have the underlying price at maturity on the x-axis. So when we buy a call option, we are paying the premium. So we start with a negative profit and loss here because we just paid the price of the option. And then if the underlying price of Bitcoin, Ethereum, or other cryptocurrency ends up being above the strike price, the option will become in the money and we will start making profit off of them. And then the break even is just the profit taking into account the option price. So this is the diagram of a call option. Now, if you want to sell a call option, you will be earning the premium. So you will start off with a profit of the option price. And if the underlying price ends up being above the strike price and above the break-even price, you will start losing money because you sold that option and it's now in the money. So now the long put option, so buying a put option, same thing. If the underlying price at maturity is above the strike, the put option is out of the money, so you will be earning, you will be paying the option price and not making profit, so you'll be at a loss. But if the underlying ends up going below the strike price and below the break even, you will start making money and making profit here, since a put option is a bet that the underlying will go down and not up at maturity. And if you want to sell a put option, you will be earning the put option price or the premium if the underlying ends up being above the strike at maturity. And if the underlying goes below the strike, the option will be in the money. And since you're the seller, you will have to pay money and you will be operating at a loss in this range here. So this was just a quick recap on the call and put options. So to discuss option strategies, a very important topic is called the put-call parity. This is essentially a no arbitrage argument in options and underlying, which is shown here in this formula. This is the formula of the put-call parity, which is divided in two parts, this part here and this part here. Now, if we want to concern ourselves with the first part on the left, it's C plus X and then the discount factor. So C is the call premium, so the price of the call option, and X is the strike price. So here we are just saying that we are buying a call option and we are borrowing X amount of money, which is the strike price, that we will have to repay in the future. So that's why we have the discount factor here. So for now, let's just consider that we are buying a call option and we are borrowing money. So we start off with the borrowed money plus the call option. So this side of the equation here is shown in this diagram here, which is portfolio A. So we are buying a call option. So we buy this payoff here. And since we borrowed money, we borrowed X amount of money, which is a strike, we start with cash. So when we add the call option with the initial cash from the borrowed funds, we get this payoff here, which is portfolio A, which is this part of the equation here. Now, if we want to look at the second part of the equation, P plus S. P is the put premium, and S is the current price of the underlying, so the price of Bitcoin or Ethereum, for example. So here, this part of the equation, we're just saying that we're buying a put and we have a long position in the underlying, which is shown in portfolio B. So we are buying a put with this payoff, and then we are long the underlying with this payoff. When we combine the two together, we get this diagram here. Now, notice that this side of the equation equals this side of the equation because both sides have the exact same payoff. Now, this is why it's a no arbitrage argument, essentially saying that if two investment instruments have the exact same payoff in the future and risk, they should cost exactly the same. Because if this side of the equation was cheaper than this side of the equation, I can just buy the cheaper one and sell the expensive one, and both of them are going to give me the same return. So I will be making a profit from arbitrage. But when the market is very liquid, you will not be able to perform this arbitrage trade because the prices of the call and the put will reflect this, and there will not be a possibility to have arbitrage. Now, it's sometimes available, but it will go away very quickly. So this topic is important to introduce option strategies because you can see here that you can replicate payoffs using different types of instruments, using puts and calls. And another nice thing about this formula is that you can switch the elements around. For example, you can say that C minus P on this side of the equation, which means buy a call and sell a put, would be equal to S minus X ERT. So this would mean that buying a call and selling a put should cost the same as having a long position in the underlying and lending X amount of money. So to show you a little bit more intuitively and visually how that works, let's consider these four types of option strategies. So first one, the covered call. So like we showed before, covered call is essentially a long position in the underlying, which is shown in this line here. And then you are selling a call option, which is shown in this line here. So you have long in the underlying here, and then selling a call option, which is here in this part right here. When you combine your long position in the underlying and selling the call, you will get this payoff, the colored payoff here. Now notice that since you sold a call option, you earned premium. So that's why you're making more money than just holding the underlying. But there's no free money in the markets. So everything is offset by risk. So if you will be making more money in this case, you will be making less money in the other case, which is here. So you're making more money if the underlying is below K than just holding, but you will have a limited upside in case the underlying goes above K because you sold that call option. So these graphs here just show how combining positions, you can draw the combined payoff of a position. Here it's just the reverse. You are short the underlying and you are long a call option, and this is the payoff you get. And here you are long the underlying and you are long a put option here. So this would be your payoff, which is the same as a call option if you notice. And if you borrowed money, it would have been shifted up, which goes back to this formula here. And then in this part, you are short the underlying and you are short a put option. And this would be the combined payoff of this position. Now let's go a little bit deeper in the strategies to show you why you might want to do them and how you can actually do them. So first of all, the covered call strategy. So how does the covered call work? Covered call, like we showed before, you are long the underlying and you sell a call option. So your payoff graph will be this. Now, why would you want to do it? Like we showed before, because you will be generating more income if the underlying goes down, but you will let go of potential profit if the underlying goes up, which is shown here. You're making more money than just holding in this part of the graph, but you will forego of some additional profit in this part of the graph. Now, a second strategy, which is the protective put or the merit put, which is long the stock and long a put option, which is shown here. When you combine both together, you will get this payoff here, which, like we said before, through the put call parity, it's similar to a long call option and then adding the borrowed money. So this strategy protects you against downside. Here you can see that if you were just holding the coin, on the downside, you could have kept losing money, but since you had a put option that protected you, you're protected against this downside and you are still exposed to upside. Now, this is more expensive, obviously, than just being long because you're buying insurance against this drop. So you'll be paying more money to have this payoff than to just have a long position. Now, the bull call spread strategy. This one combines two call options. You are buying a low strike call, so you are buying a call option with this strike, and you are selling a call option with this strike. So your long call option on the low strike starts here, and then when the price is above the strike, you will start making money. But because you sold a call at this strike, you will be losing money from the sold call, but you will also be making money from the bought call at this strike. So it will offset each other, and then you will have a limited gain. So this is a bullish setup, but you are just limiting your upside and limiting your downside. And obviously, compared to this strategy here, since you are also limiting your upside, it will be much cheaper to get this strategy than to do the previous one. So always no free money in the markets. If you're taking less risk, you will pay less money. And if you want more return, you will likely have to pay more money. Now, the last strategy, the bear put spread, which is similar to this one, the inverse of it, but it's only made through put options. So here you are selling a low strike put option and you are buying a high strike put option. So since you are selling a low strike put option, anything below this strike, you will have to pay money to the buyer. So you'll be losing money in this place. And everything below this strike here, you will be making money because you bought the strike. So that's the bought put option at the high strike. And then you get here to the low strike. Since you sold it, it will offset. And then you will have limited upside and limited downside. Now, this is very similar to the bull call spread, but it's just a bearish setup. But also, you still have a limited upside and a limited downside. So now we're going to use this charting tool to show you exactly how we are building these option strategies by combining call options together and the put options together. So recall the bull call spread, which is a bullish setup with a limited upside and limited downside, which is made by selling the high strike call option and buying the low strike call option. So here we are selling a call option with a high strike and we are buying a call option with a low strike. And for all these strategies I mentioned, we are always doing the same expiry date. So sell high strike call, buy low strike call, we generate payoff, and this is what we get. So the dark blue line here is selling the high strike call, and then the light blue curve is buying the low strike call, and then when we combine both together, we get the orange line, which is the bull call spread payoff that you mentioned earlier. Now, if I want to be on the inverse side of this, I can just buy the high strike call and then sell the low strike call, and it will just be the flip side of it. So now, we have the same, but we are in the opposite direction of the trade. And then we can do the same thing with put options. So sell put. Now we have the same payoff as we just showed you earlier. And then if we want to be on the flip side of this trade, we will just do the opposite, and then we will get this. Now notice that this is similar to a bull call spread, but we are constructing it using put options instead of call options. Now, in both cases, since they have the same payoff, this combination of puts should cost exactly the same as the combination of calls because they have the same payoff and there's no arbitrage in the markets. So this is it for today. We went through 4 basic option strategies that will help you bet on certain outcomes in the future on the underlying of Bitcoin and Ethereum or others, or it could be helpful to hedge against certain outcomes as well. For the next video, which will be a continuation of this video, we will be discussing more advanced option strategies that will allow you to bet on volatility, so be long volatility or be short volatility, basically saying that if I expect volatility to be very high in the future, but I don't know if the underlying will go up or down, either way, I want to profit from a big move, I can do a strategy called a straddle, which is shown in this orange line here, which is also a different combination of call and puts. Or I can do many other things like a long strangle, or I can start doing butterfly spreads, which will compose of a combination of 4 options. And we can do many different strategies, which I will go through in the next video. So thank you very much for watching. I hope this was helpful and see you next time.